Hello my friends and welcome back to FR Learning Phase. Today we're going to be looking at a topic that is huge in your syllabus. It actually covers a number of different accounting standards and we're going to be looking at some of those today. Now when you think about it, for most organisations, not necessarily a service level industry, but certainly manufacturing or retail, one of the largest assets on their balance sheet, especially if they own land and buildings, are going to be tangible non-current assets. Now, there are lots of accounting standards in tangible non-current assets, and we're going to be looking at one of those today. Now, the standards that we need to consider, first of all, there are those that relate to the cost, the depreciation, the revaluation, and the disposal of non-current assets. And the non-current assets we're looking at here are those that are property, plant and equipment. And the standard that covers these is IAS 16. Now we've also got other standards that look at when we've got finance costs or interest that's paid to construct a building, and those can be included as part of the cost. We need to have a look at how to deal with government grants, and we also need to know how to deal with other types of property that we rent out, for example. Now, these items are for another day, because we've certainly got enough to look at here with cost, depreciation, valuation, and disposal. Now, the cost starts off, we need to have a look at how we include property, plant and equipment in our financial statements initially. And what happens if we incur extra or additional expenses during the life of the items? We then need to think about how we're going to depreciate those. Now, you know how to depreciate non-current assets because you've talked about straight line and reducing balance basis in previous studies. But here it's more about how we account for that depreciation. And then a really big topic that we need to consider is valuation. Now we've looked at how to revalue very simple revaluations before with things like land. But the key thing we're looking at here is how we revalue a depreciating asset. Once we've done that, we're then going to have a brief chat about disposals. Now there's lots of illustrations and test your understandings, and you can expect any of these topics to be examined in a published account style question or in another short form objective testing or constructed response where you'll be looking at how to determine certain figures or explaining how something is disclosed. Now let's start first of all by considering the topics that we've just mentioned, which are the measurement, that's the initial cost, the depreciation and the revaluation. Now you'll notice that all of these are covered by IAS 16. You do not need to know the standard number or name, but you do need to be aware that IAS 16 covers property, plant and equipment, and you're going to see this abbreviated commonly as PPE in your exam. Now, PPE is defined as something that's tangible. That means you can touch it, you can kick it, you can feel it. And it's held by an entity for more than one accounting period, and we use it in the production or supply of goods and services, rental to others, or for administrative purposes. Now, for production or supply of goods or services, we think traditionally of being something like a manufacturing unit. For rental to others would be if you're a company that leases items. And for administrative purposes, it may be things like desks and chairs and computers and photocopying equipment. Now, PPE can only be recognised when it's more than likely, probable, that future economic benefits are going to flow to the entity. Now, what we mean by that is we're going to get some form of benefit from it. It's going to help us generate revenue, for example. And we can determine and measure its costs reliably. In other words, we know how much it cost us. Now, initially, any PPE will be included in the financial statements, debit asset, credit cash or liability, at its cost. And the cost is described as the cost involved in bringing the asset into its working condition. Now, that will include the cost of buying it. It will include the cost of site preparation. So if you're building a building, it'll be digging foundations. But if you're putting in some machinery, it may be where you've got to knock down a wall or raise a floor to incorporate it. It will also include any delivery costs. Now, these are costs bringing the asset to you. Installation, if somebody helps you plug it in. We'll talk about borrowing costs a little bit later, but those are also included. When we talk about revenue costs, we mean costs that aren't involved in bringing the asset to its location and condition. And any other expenditure, like training your staff, for example, to use the equipment, would be included as part of your profit or loss. What we also include in here, though, is dismantling costs. Now, sometimes you will build, let's say that you set up an oil rig. You build some machinery to be able to drill for oil. And you have to take that machinery down at the end of its useful life. But that machinery is not going to be taken down for several years. What we need to do here is to estimate what those dismantling costs are going to be. Using present value techniques, identify the present value of those costs and include the item in the statement of financial position initially at that cost. You will then depreciate it. The corresponding credit will go to liabilities. And as you get closer to paying that dismantling cost, the present value of that liability will increase. Let's have a look at this illustration number 1 here. If an oil rig was built in the sea, the cost to be capitalised is likely to include the cost of constructing the asset and the present value of taking it down. If the asset cost 10 million to construct and would cost 4 million to remove in 20 years, we have to calculate the present value. Now, in a question, you would get told what the interest rates were to identify the present value. Here we're told it's 5%, and the discount factor at 5% in 20 years multiplied by that cost will give us the present value of that dismantling expenditure. So the amount that we're going to include as the cost of the asset on day 1 is the 10 million plus that dismantling expenditure. This total would then be depreciated over the remaining 20 years. Now, the corresponding liability, so this figure here will be debited to the asset and then depreciated and credited to the liability. So the liability is going to be unwound every year, and you take 5% of whatever its balance is at the end of every year and increase that liability. So at the end of 20 years, you would have a liability in the statement of financial position of 4 million, which would then represent the amount that you owe for dismantling. The credit goes to the liability every year. The corresponding debit from that unwinding is called a finance cost and is put through the statement of profit or loss. Now, test your understanding number 1 gives us an illustration of how we put together the initial cost. In here, we've got an entity that started building a building on the 1st of April, and we have a list of costs down here. We're then given some additional information. The first one is about the materials, and the second one is about the labour. The third one is giving us an indication of when we can start depreciating, so we'll talk about that in a moment. We're going to work out which of these costs are included as part of the initial cost and identify those that are revenue items that would not be included as part of the cost. Now, the purchase price of the land is an initial cost and would be capitalised. Stamp duty is also a cost of bringing an item to its current location. So are the legal fees that we need to incur to buy the premises, and any site preparation and clearance would also be included as part of the preparation of the asset. Now, I can also tell you that the architect's fees that will be incurred in designing the build are included, but the general overheads are not. These would go to the statement of profit or loss as an expense. Now let's have a look at the material and the labour. We're told that we spent 100,000 on material, and on investigation we found that 10 million, notice that that's actually 100 million because of these noughts up here, 10 million has been spoiled and wasted, and a further 15 million was incurred on materials as a result of faulty design work. In other words, 25 million of the 100 million is going to be treated as a revenue expense. So what's going to go to the statement of profit or loss is 25 million, and 75 million would be included as part of the cost of the asset. With the building, we're told that work on the building ceased for a fortnight in October, and it's estimated that 9 million of the labour costs resulted to that period. So in other words, what's going to go through the P&L is the 9 million abnormal expense, and the remaining 141 million is therefore going to be a cost of the asset. Now, I think that this means that the total cost of the asset is going to be 250 plus 5 plus 10 plus 18 plus 75 plus 141 plus 20. So in total, 519,000 is the cost of the asset. The items that are going to go to the profit or loss, which I'm going to put in here, are going to be the 25 and the 9 plus the 30. Now, the reason that they're telling us that the building is completed on the 1st of July is because we then know that this cost will then be depreciated at the time it was completed from the 1st of July. Now, sometimes we find that we put this asset in when we first buy it, and then we start spending more money on it as time goes on. We call this subsequent expenditure. And we can either capitalise, in other words, we add it to the value of the asset, or we treat it as revenue expenditure. That means we take it to the statement of profit or loss. Now, the general rule is it is capitalised if it meets the definition of an asset. In other words, it enhances the value of the item, or it relates to an overhaul or required as part of a major inspection. And I'm going to give you an example of that. Now, let's have a look down here at illustration 2. A piece of machinery has an annual service costing 10,000. During the most recent service, it was decided to replace part of the engineering, meaning that it will work faster and produce more units per hour. The cost of the replacement part is 20,000. Would this expenditure be treated as capital and added to the value of the asset, or revenue, which means taken as an expense? Now, I would argue that the 10,000 service cost is not enhancing the value of the item. It is simply maintaining the item at its current standard. So this means that the service cost is taken to the statement of profit or loss. The replacement part enhances the value of the equipment. What we're saying is that it actually makes it better, it makes it faster, and it makes it more productive. So the 20,000 can be capitalised and will be added to the value of the asset. Now I'm going to talk about how to deal with an overhaul once we've finished the depreciation. Now the next consideration that we need to look at is how we deal with depreciation in financial statements. You know already the difference between straight line and reducing balance. We're not really interested so much in that here. What we are interested in is how that depreciation is accounted for. And you know that what we do is we take it to the statement of profit or loss, either as an admin, distribution or cost of sale, depending on what the equipment's for, and we then have a corresponding reduction in the value of the property, plant and equipment. Now it's worth noting that you do not decide what the depreciation method is. The directors decide what the depreciation method is depending on how they use the asset, and they have to reflect as fairly as possible the pattern of its use. And that will determine whether we take the same amount every year, or we apply reducing balance, or perhaps we base it on the amount that it's used. Now, what you will need to be aware of in your syllabus is what happens if the directors decide to change what we call an accounting estimate. This is either the useful life, the estimated residual value, or the depreciation method used. And directors have to make sure at the end of every reporting period that the useful life, depreciation method used, or the estimated residual value is a fair reflection of what these figures should be. And if they find at any point in time that they need to be changed, then they have to be changed in the financial statements. And we call this a prospective change. And what that basically means is that we're going to be changing the depreciation amount from this point forward. And illustration number 4 is going to explain that for us. An entity bought an asset for 20,000 on the 1st of January X3. Straight line depreciation of 5,000 per annum has been charged, assuming a 4-year useful life with no residual value. So in other words, this was taken, we divided it by 4, and we got depreciation of 5,000 a year. On the 1st of January, the annual review of the asset lives was undertaken, and the remaining useful life for this asset is now estimated to be 4 years. Now you'll notice that this is 2 years on. So effectively what we've done is we've changed how long we're going to be using it. Now we're not changing the method of depreciation. We're keeping the residual value as 0. We're just changing the useful life. So what we're going to do down here is explain where we are just before that change. So the carrying amount would have been the 20,000, and by December X4 we would have taken 2 years worth of depreciation. And the depreciation would therefore have been 10,000, giving us a carrying amount of 10,000. On the 1st of January, we now have another 4 years useful life. Notice how we don't go back and change previous year's financial statements, but we take from now looking forwards, and what we're doing is writing off that figure of 10,000, that's this figure of 10,000, over the remaining 4 years. Now we call that, and we're going to talk about this throughout our studies actually, this is called a prospective change. In other words, we're not changing previous year's financial statements, we're taking this change in estimate and looking at it moving forwards. Now, more subsequent expenditure, which we mentioned before and talked about this being of a capital nature, is something called a major inspection or an overhaul. And when you've got an item of equipment that needs a major inspection or overhaul at a regular interval, and the best example I can give you of this is an aircraft, which according to aviation law needs to be overhauled at a certain number of years or a number of flying hours, depend which comes earlier, then what we do is we treat the two items, that's the main equipment and the overhaul, as two separate items. Now let me give you an illustration. Here we have an entity that buys an aircraft that's got an expected useful life of 20 years and no residual value. We know that it requires a substantial overhaul at the end of years 5, 10 and 15. The aircraft cost us 25 million. Now what we're going to do is we're going to establish on day one what we think that first overhaul is going to cost us in 5 years' time. And here the company has decided it's going to cost us $5 million. So we're going to assume that of that 25 million, 5 million relates to estimated overhaul costs, and the balancing figure of 20 million is going to relate to the aircraft. What we then do is we treat this aircraft as, I can't draw at all, there we are, my aircraft. The aircraft is going to be treated as two separate assets. The 5 million is going to be written off over 5 years, and the remaining asset is going to be written off over its useful life of 20 years. So for the first 5 years, you've got 1 million depreciation on the overhaul and 1 million depreciation on the asset. When you get to the end of year 5, the value that relates to the overhaul has now gone. It's been depreciated. You then spend money on your overhaul. And we're going to say in this example, let's say that this is 6 million. So at the end of 5 years, this has gone. We then put in 6 million and we're going to write that off over the next 5 years. Meanwhile, we're still depreciating the rest of our aeroplane over 1 year. So we've still got that over 1 year, and we've now got this 6 million being depreciated over the next 5 years at 1.2. And then at the end of the next 5 years, you look at the overhaul, you put that in again. Now, what we're trying to say here is that this aircraft is what we call a complex asset. It's made up of two components. It's made up of the main body of the plane, and it's made up of the engines, which then have to be overhauled. And we treat the two items as two separate assets. Now, the next topic that we're going to have a look at when it comes to non-current assets is revaluation. As you know from your earlier studies, property, plant and equipment can either be valued using a cost model or a revaluation model, and it is the company's choice which it chooses. There are some rules regarding which assets it will need to choose to revalue in a certain way, but just notice down here that regardless of the method, you still deduct depreciation. Revaluing just means that you revalue at a regular interval. Now, if you choose to revalue, there are two conditions that need to be complied with. The first one says that revaluations must be made with sufficient regularity to make sure that the asset is always shown at its most up-to-date value. It doesn't say how often sufficient regularity is, but you would normally assume that if you know, for example, that assets that you've revalued have gone up in value or down in value, then you need to carry out a revaluation. Also, we need to make sure that if you choose to revalue a particular item of property, plant and equipment, everything in that class needs to be included. Now, what this means is that you could choose to revalue buildings, but not equipment, and that's fine. But if you do revalue buildings, you need to revalue all of them in that class. Now, once you've decided that you're going to revalue and you've got a revaluation, one thing I would tell you to do in the exam question is to look out for the date. If the item has been revalued at the beginning of an accounting period, it means that you revalue it and then you will depreciate it to get to the carry forward figure at the year end. If, on the other hand, you revalue at the end of the year, it means that you take the original carrying amount and depreciate that before you revalue. And the amount that goes to the revaluation reserve would be different depending on when the date occurs. Now I'm going to be pointing this out to you as we go through some illustrations. Notice that when we revalue a non-current asset upwards, we increase the value of the cost account. We'd eliminate any accumulated depreciation by crediting it, and the credit goes through other comprehensive income, then it goes into SOCI, and finally it gets shown as a revaluation surplus in the statement of financial position. Now please note that all non-current assets that are revalued have to be revalued separately, and gains and losses are not netted off against one another. So you may find that in 1 year an asset goes up in value and another asset might go down in value. Treat them separately, think of them having their own revaluation surplus. Now, let's have a look at a couple of examples. And I'm going to talk about all these points in a nice little illustration called Test Your Understanding number 2. Now here, we're asked to prepare extracts of the financial statements. So we're going to show what's in the statement of profit or loss, what's in the statement of changes in equity, and what's in the statement of financial position. Now, we've got down here a company that at the beginning of a period, notice it's got a year end of March, the fair value of the property is 100,000 and it's got a remaining useful life of 20 years. The policy is to revalue a property at the year end, and at the end of the year the property has gone down in value to 86. The balance on the revaluation surplus was 20,000, which relates entirely to this particular property. And it then says that we don't make a transfer. I'll talk about that later on. So let's just talk very briefly about how we're going to deal with this. Now, we start first of all, and if in my answer, I'm going to explain what the extracts would be. I want some extracts from the statement of profit or loss. Now in here, I'm going to see what the depreciation will be. And then in other comprehensive income, we're going to show the movement on the revaluation surplus. In the statement of changes in equity, we're going to see that there will be a revaluation surplus with a brought forward, a movement from TCI, and a carried forward. And in my statement of financial position, I'm going to show what my property, plant and equipment will look like, and under equity, I'm going to have my revaluation surplus. Now, when your examiner asks for extracts, what they're saying is, you tell me where it goes in these particular statements, but you don't have to draft the whole statement, just literally show the relevant extracts. Now, let's work out what we've got to put in here. Now, if we go back to our question, we can see first of all that this has been revalued at the end of the year. I bring it forward, I depreciate it, and then I revalue. So my depreciation expense here is going to be following this rule. So it's going to be based on the original carrying amount. So my depreciation is going to be the 100,000 brought forward over the 20 years. And this is going to give me a value of 20,000 expense. No, it's not. It's going to give me a value of 5. I can't do my... Terrible without a calculator. 5,000 depreciation. Now I'm going to put this in as brackets because it would be a negative against that and it would be shown as an expense. Now this means that the statement of financial position would then give so far a valuation of 100 less 5. It's got a value of 95 sitting in the books. Now, we know in the question that the revaluation surplus at the beginning of the year is 20. Therefore, in my statement of changes in equity, I would have 20,000 brought forward. Now the question tells me that I've then revalued to 86,000 at the end of the year. So it's going to go from 95 down to 86. Now the way that I normally set this out, if I'm doing my double entry, is I would reduce the cost account from 100 down to 86. Whoops, going the other way. So I'm going to reduce the PPE cost by 14,000. I'm going to take out the accumulated depreciation of 5. And I've then got a reduction that goes through revaluation surplus of 9. Now notice that that 9 is the difference between the 95,000 and the 86. So what I'm going to put through here is my PPE is going to be shown at 86,000. That will be the new value. PPE will have depreciation of 0 and a cost account of 86. The revaluation surplus is going to go down by 9. And therefore, my statement of changes in equity would have a balance of 11 at the year end. And in the statement of financial position, I would then have 11,000 revaluation surplus. Now that one was a reduction in value. Let me show you what would happen if we had land and buildings that went up in value, but also let's have a look at what this means. Now, what you'll find is that by revaluing a non-current asset upwards, it has the effect of, once you depreciating it, creating a larger depreciation expense in your statement of profit or loss. What this does is reduces your retained earnings. It reduces the amount of profits, therefore, that you can pay to your shareholders as dividends. So what we're going to do is to transfer a sum from the revaluation surplus through SOCI to retained earnings to compensate for that loss in value. And the amount that you take out is the additional depreciation that's being charged as a result of revaluing. Now, in this example, I'm told that I've revalued my buildings at the start of the year to 60 million with 15 million for land. The property had cost me 30 million and 6 million for the land. The total expected useful life of 40 years remains unchanged, and I've got to show the effect on the financial statements. Well, again, I'm going to be looking at basically my statement of profit or loss, which is going to give me depreciation, and then under other comprehensive income, I'm going to have my revaluation surplus. In SOCI, I'm actually going to show you here the movement between the revaluation surplus and the retained earnings. Oops. So I'd have a brought forward, a TCI, and a carried forward. And in the statement of financial position, again, I'm going to show you where we've got non-current assets, land and buildings, and also under the equity section, we've got the revaluation surplus. Now, let's do a little working down here to see what's going on. Now, remember, we've done this at the beginning of the year. So what we're told in the question, first of all, is at the beginning of the year, we revalued our land from 30 to 60. So what does this look like if we're looking at the workings? Well, I'm just going to break down land and buildings here because obviously land is not depreciated and buildings are. So the cost is 6. I think I might actually, these millions, let's have a look at what this is. Did we say this was millions actually? Let's get rid of these noughts then. We've got 6 million. and we've got 24 million, giving me a total of 30. We're then told that this is depreciated over a 40-year period. Now, if we look at when we bought this 10 years ago before we revalued it. So therefore, 10/40ths or 1/4 would have been depreciated to date. So at the beginning of the year, carrying amount would have been 6 and 18. We then revalue at the beginning of the year, and we've said that we've revalued to 60. 15 for the land, which must mean 45 for the building. So we therefore got a revaluation surplus of 9 positive for the land and 27 for the building, giving me a total of 36 million. And then this year we've depreciated. Remember, it said that we've not changed the useful life of the asset. We're still assuming it's got a 40-year life overall. 10 years have gone, 30 are left, which means that we've got 1.5 million. I think that's 45 divided by 30. It's going to give me 1.5 million depreciation for this year. So in other words, the land has got a value of 15 and the building's got a value of 43.5 million. Now, when you look at the depreciation, notice how much extra depreciation is being charged every year as a result of the revaluation. If you take the original depreciation, it was 24 million over 40 years, which was 0.6 million every year. Now the depreciation is 1.5 million. It's gone up by 0.9 million every year. And that's going to give me my annual transfer figure, because I'm saying that as a result of revaluing, I'm charging 0.9 million more depreciation every year. So when I go up here, in my depreciation figure, I'm going to put the amount that I incurred this year. So this is all going to be in millions. I've got 1.5 million expense. My revaluation surplus, if I've never revalued before, has now gone up by 36 million. In my SOCI, my brought forward revaluation was 0. I don't know what my retained earnings are. My revaluation gain is 36 coming out of OCI. And then what I'm going to do is I'm going to include this transfer of 0.9 million, which I'm reducing, debit, revaluation surplus, credit, retained earnings. And that's the transfer figure. Now you'll notice I've done that because in the question it says we make a choice to do it. You don't have to do it. Notice in the previous test you're understanding, they didn't choose to do it, so we didn't do it. And an exam question will need to make it very clear for you. Now, having done that, that would then give me my carried forward surplus. My PPE is now going to be valued at whatever the value was that we said before. I don't think I worked that out, did I? Which is a bit naughty. This is going to come to 58.5 million for the land and the buildings. And the revaluation surplus is the 35.1. There's a lot to do, isn't there, when you're revaluing? Now, it's worth getting your head around that. A lot of published accounts questions will ask about revaluing assets. Now, when it comes to disposing of a revalued asset, the problem you then have is that you've got the revaluation surplus relating to it, and you've also got the PPE. And we've got to make sure that when we dispose of non-current assets, we remove every single trace of it from the financial statements. Here we have Derek that bought a property costing $750,000 on the 1st of January with a useful life of 10 years. It's got no residual value, and at the end of December the property was valued at $810,000, resulting in a gain on revaluation of $135,000. There was no change to the useful life. We do not make a transfer like we've just seen in the previous Test Your Understanding. And at the December X6, the property is sold for $900,000. We've got to work out how this is accounted for. Now, the sale proceeds of $900,000, I'm going to do all of these in thousands, $900,000 is then going to be compared to the carrying amount. The carrying amount is the $810 less the depreciation. Now, the depreciation on that, if we had a useful life of 10 years and 1 year after acquiring it and we haven't changed the useful life, we then carry on depreciating, it means that we're going to be taking 1/9 of that value every year. Now, from the date that it was revalued to the date that we dispose of it is 2 years. So the depreciation that we've got to date is 180. Therefore, the carrying amount of this item is the revalued figure less the depreciation to date, which is 630. Therefore, the gain that's going to go to the statement of profit or loss is going to be the difference of 270. But I've still got this revaluation reserve of 135,000 in the statement of financial position. So I need to remove the revaluation surplus relating to that item, again in thousands, and I'm going to put a transfer to retained earnings. Now, do you remember how we dealt with this when we looked at the previous Test Your Understanding? We highlighted the fact that we had this transfer between the two. And the journal that I've just given you for 135 would be dealt with in the same way. You deduct it from the revaluation surplus and you add it to the retained earnings. Now, we've gone through quite a lot, haven't we, in this particular section, but it is very, very examinable at FR. So make sure you understand how to deal with the initial cost and subsequent expenditure, how to account for depreciation, including when you revalue and taking note of those transfers between retained earnings and revaluation, and also learn how to account for disposal. I'll leave you to look through those notes, my friends. Enjoy, and I very much look forward to seeing you next time. Bye for now.